Imagine waking up tomorrow to discover your home, your biggest investment, your slice of the American dream, has lost half its value overnight. Not from some distant crash, but from a silent implosion already devouring neighborhoods from coast to coast. Hit that subscribe button right now and drop crash in the comments if you're ready for the raw truth the headlines won't touch. Because what I'm about to reveal will shake everything you thought you knew about money, debt, and the roof over your head. The U.S. housing market isn't cooling off. It's quietly detonating while most Americans scroll past the warning signs. Total mortgage debt has blasted through $12.7 trillion. Yet the typical family pulling in $78,000 a year can now afford fewer than 1 in 5 homes on the market. A gut-punch drop in buying power that hasn't been this brutal since the mid-'80s. Back in 2021, a $400,000 loan ran about $1,600 a month at 2.6%. Fast forward to today, and that same loan at 7.8% sucks almost $2,900 out of your pocket every 30 days, effectively tripling the monthly bleed in under 4 years, while paychecks barely crawled 10% higher from $71,000 to $78,000. Home prices, meanwhile, rocketed from $329,000 median to over $420,000, creating a 90% gap between what people earn and what it takes to own, forcing the average worker to fork over 45% of gross income just to keep the bank happy. Numbers that shatter every safe lending rule in the book and trigger an automatic credit lockdown as banks slam the brakes on approvals. Every single percentage point jump in rates wipes out roughly 5 million would-be buyers, a stealth purge you'll never see on cable news. Pending sales are already down 16% year over year, mortgage applications just hit a 28-year low, and builder confidence has cratered to crisis territory. Sunbelt powerhouses like Florida, Texas, and Arizona, once unstoppable, now hemorrhage inventory faster than the 2008 meltdown, with Austin prices off 18%, Seattle 13%, Phoenix 15%, and builders slashing tags 20% or more just to stay alive, while their sentiment index wallows at 33%, anything south of 50 screaming contraction. Liquidity is evaporating faster than prices can fall. New originations plunged 55% from the 2021 peak, the sharpest nosedive on record, leaving realtors, appraisers, inspectors, and lenders staring at empty calendars as the credit pipelines that once pumped trillions into local economies freeze solid. Behind every unsold listing sits a chain reaction of frozen commissions, unpaid contractors, stalled permits, and axe developments that ripple out to drag furniture orders down 24%, appliance sales 17%, and residential construction spending 12% in a single year, the worst since the pandemic lockdowns. Housing-related activity still accounts for up to 18% of GDP, so if this contraction holds, expect a 1.7% drag on growth by early 2026, enough to shove the entire country into recession even without a banking panic. But the rot doesn't stop at stretched families. Wall Street engineered the sequel to 2008 by vacuuming up 1 in every 5 single-family homes, funding the spree with labyrinthine credit lines, synthetic bonds, and rent-backed securities that make the old subprime mess look quaint. When rates spiked, these giants didn't quit borrowing, they just pivoted to private credit funds, watched bond values implode, and triggered a hidden cascade of margin calls and forced liquidations, now dumping properties at 15 to 25% haircuts just to patch balance sheet holes. A billion-dollar portfolio refinanced at 3% in 2021 now resets above 7%, doubling debt service overnight and shredding the spreadsheets that once justified nosebleed valuations. Small investors who piled in at the top are now trapped as comps crater, while banks nursing mark-to-market losses slash liquidity even further in a vicious deleveraging spiral. Active listings have exploded 29%, floating a market with 0 qualified buyers. Homes that flipped in 72 hours now gather dust for 53 days on average. Condo inventories in Florida have doubled, and the national bloodstream of money velocity has flatlined. Early-stage mortgage delinquencies are up 28% year over year, Americans defaulting on homes before cars for the first time ever, while the average loan balance hits $267,700 and total household debt tops $18.6 trillion, larger than the entire U.S. economy itself. Disposable income is devoured by survival costs. Energy bills up 22%, property insurance 38%, taxes surging statewide, leaving the median family hemorrhaging 43% of take-home pay on housing alone. Savings rate languishes at 3.8%, one of the lowest in 50 years, while credit card balances smash past $1.33 trillion, Auto loans and personal debt spiking over 20% since 2023 as families raid revolving credit just to cover the mortgage gap. Construction job growth collapsed from 3% to 1.4%. Subcontractors canceled projects at 2009 levels. Layoffs quietly gut mortgage brokers, moving companies and suppliers, creating a self-feeding loop that infects every industry tethered to home building. Regional banks gorged on property exposure watched deposits vanish. Warehouse leases tied to home goods tank. Freight hauls of lumber and concrete grind to a halt. And thousands of small firms vanish without a headline. Consumer confidence in buying a home just hit the lowest reading in Fannie Mae's entire survey history. Only 14% think it's a smart move. Psychological surrender that kills demand faster than any rate hike. The Federal Reserve printed $6 trillion from 2020 to 2022, shoved real yields negative, ignited bidding wars and instant sales above ask, then flipped the switch with the fastest tightening in 40 years once inflation crested 9.1%. Shelter costs, the very metric hikes were meant to tame, stay sky high because locked-in 2.5% borrowers refuse to sell, new buyers can't qualify, and construction funding has dried up, paralyzing supply while every fresh rate bump multiplies defaults and strangles tax revenue. M2 money supply shrank over $1 trillion, a deflationary gut punch, unseen since the Great Depression, and the credit impulse that actually drives growth is flat dead. Cut rates and inflation roars back. Hold steady and insolvencies snowball. There is no clean exit, only slower or faster collapse. Meanwhile, the smart money has been ghosting for quarters. Institutional sales surged 62%. Bulk buys cratered to 2012 lows. Hedge funds and REITs offload entire rental portfolios at 15 to 25% discounts to meet maturing debt, injecting short-term cash but accelerating the price death spiral. Repo markets tighten as collateral quality rots, capital flees to treasuries and commodities, leaving an over-leveraged housing complex gasping for oxygen. Foreclosure filings are already up 28%. Real estate ETFs trade 30% below net asset value, and independent models forecast 35 to 70% corrections in bubbled markets as price-to-income ratios blow past 7 to 1, a level no economy has ever sustained without implosion. By 2027, entire Sunbelt subdivisions will hit the block simultaneously as investor portfolios unwind. Supply will tsunami while credit vanishes, and every 1% delinquency pop will shave another 5% off values. We're already past 2%. Property tax coffers will shrink, city budgets will hemorrhage, services will vanish, and the middle class will wake up to discover the system never intended to protect them, it was built to extract. The greatest housing crash of our lifetime isn't looming, it's here. Bleeding out one empty house, one missed payment, one shattered illusion at a time, and the reckoning won't just be financial, it will be the moment millions realize the American dream was leveraged into a nightmare. Smash the bell, share this with anyone still sleepwalking through their mortgage statement, and let's keep exposing the math they don't want you to see.